Hi everyone, Erwin here. I've been a real estate investor in Ontario since 2005, done over 40 properties personally, and starting about 2 years ago, I started selling off my portfolio because I found better opportunities in the States. And I'm happy to share with you why. And the question, this is probably the number one question I get between is now a good time to buy with the way the Canadian dollar is? And of course, unless you've been living under a rock, we're in the middle now of a trade war with the Americans. So the question is now a good time to buy a US investment property? Let's get into it. So at time of recording, we are at 69 cents. $1 gets you 69 cents American. And we've been steadily falling for the last year or so. And again, in case you missed it, Donald Trump, this is straight from from True Social. He's saying that he will unleash the American energy production, slashing regulation, rebalancing international trade, another nicer way of saying tariffs, and reigniting American manufacturing. And then in the pink there, it says stopping inflation. It's actually, if you've studied Economics 101, then you know that everything he's discussed so far is inflationary. The Treasury is going to lead the effort to cut unnecessary regulation and will unleash lending for all American people and businesses. So remember, Economics 101, investment is inflationary. Reshoring American manufacturing is inflationary. Tariffs are inflationary. Lending is inflationary. So all these things are expected to increase. So what do you think is going to happen? And then again, at the time of recording, Trump just announced that he's enacting billions and billions of dollars of tariffs against Canada, also Mexico, and also a little bit against China, and Europe is on his radar as well. Now, people are asking, like, how long will these tariffs go for? So if you actually see what the Treasury Secretary has been talking about, Scott Bessent, I think I said that correctly, his suggestion was to add 2.5% of tariffs each month, capping out at 20%. So month 1, 2.5%, month 2, 5%, month 3, 7.5%, eventually get to 20%, and that'll be the cap. His intention was to give countries a chance to renegotiate contracts and adjust. Donald Trump wasn't so patient. So point is, these tariffs may be here to stay. And this is from December from Yahoo Finance. The number 3 and number 4 sources of inflation in the US is, number 3 is rent, number 4 is housing. So what is a pragmatic investor to do? Trump's objective is to bring more manufacturing to the Americas, specifically the United States of America. And it was just in the news on the weekend, there's actually two startup Canadian food companies. They're looking to open up operation in the States. And they're not the only ones. A KPM survey that found almost half of the Canadian businesses plan to move more investment and operations to the United States. So Trump is getting what he wanted: more investment, more jobs in the United States. Now, these tariffs mean the projection is 500,000 loss of jobs in Ontario. Ontario is going to get the worst in Canada, and that's from Doug Ford, the Premier of Ontario. Now, keep in mind, last time we had a crisis in the pandemic, Ontario introduced rental freeze for 2021. Now, everything I've discussed to this point has been inflationary. Tariffs are inflationary. Canada, the Prime Minister has announced tariffs on US imports as well. That is inflationary. Do you want to be in an asset that's rent controlled during inflationary times? And we also have precedent where during difficult economic times, the province has they canceled evictions. So do you really want to be investing in somewhere where there's a precedent that there is no raising of rents and then possibly a pause on evictions? Investments here, they just really don't cash flow. Here's an example on the left, there's an example of a condo in Toronto. On the right, there's an example of a Kitchener duplex, right? And cap rate, it's okay if you don't know cap rate. It is the most common metric among commercial and sophisticated real estate investors. So cap rate, put simply, if you paid all cash for the asset, what would your cash return be? One easy way to put it. A Toronto condo, conservative math, I always run my numbers conservatively. 2.3%, that's your cap rate on a Toronto condo. On a duplex in the periphery of the GTA, say like Hamilton or Barrie or Oshawa, in this case this property is from Kitchener-Waterloo, Cambridge, cap rate 3.7%. Again, if you paid all cash, that would be your cash on cash return. That is your return, that is return on investment in cash dollars, 3.7% on a duplex. Now here's an example that I really like. Kansas City, Missouri. 3-bedroom, 1-bath, almost 1,200 square feet. The price of this property is $175,000. The rent is $1,395. Estimated appreciation, 4.6%. That's estimated annual. Of course, these are just projections. The cap rate is 6%. Right? Let's just backtrack 1 second. Again, that duplex, 3.7%. The single-family home in Kansas City, Missouri, 6% cap rate. Which would you prefer? And of course, this is in a landlord-friendly area. The house is renovated already, so this is what we consider turnkey. Lovely pictures, lovely property, big lot as well. The Americans like their big lots. And then, about Kansas City. Well, based on U.S. Census Bureau data, unemployment is falling in this particular zip code. Population is rising. Median household income is growing. And in turn, from Zillow, real estate prices have been steadily, continually increasing over time. Now, some food for thought. I did some analysis on the current Canadian dollar. The most common question I get from Canadians or objection is that, is now a good time to buy because the dollar is down so much? So here's a simple table that I created with the help of ChatGPT. How much an investor has potentially lost in just in foreign exchange. So for example, if to compare a 75-cent dollar, Canadian dollar, a Canadian potentially lost $7,200. On the lower end, 72 cents for an American dollar, you're somewhere around $4,300. So then my thinking was, how much appreciation do I need to break even? So that was literally my prompt to ChatGPT. How much does the house need to appreciate to break even to cover my foreign exchange loss? So to cover that foreign exchange loss, the property must appreciate on the high side, 2.8%. On the low side, 1.67%. Right? This is a small appreciation hurdle for most US real estate markets. And again, this specific property is expected to appreciate 4.6%. And again, that was before all these trade wars started happening and Trump promising to stimulate the economy. So, risk mitigation strategies. My clients and I, we're getting mortgages in the US, so we're mitigating our risk that way as well. Our revenue is paid in US dollars. Our biggest expenses are all in US dollars as well. We're keeping profits in the US. And to be honest, my clients and I, we're all looking to leave our money there in order to scale our portfolios there. Long-term appreciation and cash flow will offset short-term foreign exchange fluctuations. I'm personally in it for 10 years and beyond, and my goal is actually to hand this property portfolio in the States to my kids. So, key takeaways: more housing inflation should be expected. Foreign exchange risk is real but manageable. Market appreciation can offset foreign exchange losses. U.S. real estate provides strong long-term diversification for pretty much every Canadian investor out there. So next steps, look for U.S. properties that cash flow, structure your financing smartly. We have contacts for all these sorts of things. Hold and reinvest within the U.S. Monitor appreciation trends. And if you like this information, please feel free to like and subscribe. And there's lots of free resources in my bio.